Fair value gaps are all over our charts these days, and they're getting a lot more attention, especially on social media as of late. And so even more reason to understand what a fair value gap is and a futures trading strategy that we can create for ourselves to profit through fair value gaps. So with that said, by the end of today's video, you're going to be able to identify fair value gaps on your own charts, whether you trade crude oil, whether you trade the S&P, the NASDAQ, it doesn't really matter. And then from there, we're going to be able to build and devise a trading plan that gives us positive risk reward, ideally better than a 1-to-1 risk reward ratio, and a way to start to customize this for ourselves and our own trading. First things first, what is a fair value gap? Okay, so right now we have a chart of the S&P micro futures, which would be our best recommendation for those of you who are looking to get into the futures game. If you want to start dabbling on the S&P, trade the micros. Even if you want to go to crude oil, trade the micros to get your feet wet before you start upping the sizing through other future products that you have out there. And there are plenty where that came from. So I'll zoom in right here. We're looking for our bigger areas of price movement. So really, you can spot fair value gaps potentially in some of these movements, but these are small candlesticks. We want to look for those bigger movements. So we can see the bigger movements here. You can sort of see that there, but kind of choppy. Bigger movements here, some bigger movements there. We're looking for those bigger movements. And so the easiest one to look at is this guy right here for the demonstration of this video. And like anything else, fair value gaps are not 100%. By no means do they have to work. No, it does not equal this works all the time. Everyone gets so caught up in that, but it's a way that you could put yourself, again, all you need is that plus side of 50-50, right? Get to 55%, get to 60%, and you're golden. I know for myself, past couple of months, I was in this range between 55 and 65% in terms of my win rates on different strategies. And that was great, worked fine, but you don't need to be, 100%. It doesn't need, your trading does not rely upon you winning every single time. So kind of a disclaimer, but also like just the reality. I think most people should be familiar or aware of that. But if you're not, well, now you are. Okay, so with the area we have circled right now on the chart, what's the fair value gap? Well, there's 3 candles that have to be involved. So you need to understand candlestick patterns. If you don't, we've got a great video on the channel covering candlestick patterns. But the first candle of a big move is this guy right here. Here's our second candle and then our third candle. So I'm going to get rid of some of these lines here so we can kind of clean this up and show you a little bit better. But I'm going to mark these off with a 1, 2, and 3. So I'm going to go 1, I'm going to go 2, and then let's call this bad boy 3. And that's this green candle here. So the first candle, we mark the top. I'm going to mark the top of the first candle, and it's the top of the wick, okay? The second candle, we leave alone. And then the third candle, we mark the bottom of the wick of the third candle. And in this case, that's what we do if the market is trending up, if the movement is up. I'll show you an example on the downside here in just 1 second. But this blue line, this box we've now created is our fair value gap. So I'm going to use my box tool here on TradingView. I'm going to create this box. Now I'm going to move this fair value gap over as far as I want. Now, when this is occurring, and I'll show you kind of more of an example of it in real time. When this is actually occurring, we don't know if it's going to come back here, if it's going to retest it, or how long it's going to be. But we're going to bring this across, and we're going to use this in the future. Now, that is a fair value gap, and you'll realize or see that price pretty much respects this fair value gap beautifully 2 times in the days following this move. We're looking at a 1-hour chart, so it's kind of looking at the past or looking at a series of days to about a week or 2 on the bottom or across the time horizon. And so you can see that a couple days later, this area worked out as a really nice dip buy zone, and the market ended up trending higher, and you could have traded this to the upside and made money with this fair value gap. So in a nutshell, that's a fair value gap. We're looking at 3 candles. The middle candle we leave alone, but the top or the bottom of the first candle and the second candle, in this case of a move up, we use the top of the first candle, the wick is included, and then we use the bottom of the third candle, wick included, on a move down. For example, let's say you had a look like this. We would use the bottom of the first candle and the top of the third candle, and that would create our fair value gap that we can extend over to the side in a move down, and I'll show you a live example of that here in just 1 second. But before we do that, I do want to thank the sponsor of today's video, Jigsaw Trading. Jigsaw Trading offers traders an edge in the markets through powerful and intuitive trading software. With advanced tools for order flow analysis, visualization, execution, and advanced analytics and trade journaling, Jigsaw Trading gives traders a real-time view of market activity and helps them make better informed trading decisions. Whether you're a beginner or an experienced trader, Jigsaw Trading has something to offer, from their starter package to their professional package. Plus, their team of expert traders is always available to provide guidance and support. Take your trading to the next level with Jigsaw Trading. 14-day money-back guarantee. Try it today. Thanks for Jigsaw for sponsoring today's video. Okay, awesome. So let's go do a live example where we spot a fair value gap to the downside and then build out a trading plan around that with nice risk reward that would work in our favor. Talk about stop losses because that's the first priority here. Now, this is where things get a little more interesting, but we'll dive into that in a second. Okay, so here's an example where the S&P was pushing to the upside. Then we had this substantial move down. So we're kind of grinding up nice and easy, and then this big red candle comes in and we start to move down. So once we see a big fat red or green candle, now is where we can look back to the candle that led up to that, the preceding candle, the candle before that, and then see what happens with the candle after. Once we have that, we've got a fair value gap. Now, just because we have a fair value gap does not mean we need to do something this second. And this is why I think it's actually a really good strategy or a really good approach for swing traders or for someone who wants to kind of zoom out. Now, you could do this on shorter term time frames, and it certainly can work, and it does work, but we're going to use the 1 hour chart as an example. I think it's a better way for someone who is just getting involved to start to look at things, and then you could narrow it into the shorter term time frames, the 5-minute and 1-minute charts if you want to, and as you see fit, as you level up or at least scale up your own trading. Okay, boom. So the next candle is in, and what do we see here on the S&P? What we notice is if I bring this bad boy into a range, we have a fair value gap that has established. So we have, now we're looking to the downside, okay, because we've got a move down on these candlesticks. So we have a low here of the prior candle and a high here of this candle, okay? So now we got a nice move. When it comes to fair value gaps, you can spot them a lot more often than you probably need to. That's why we want to look for the outlier candles. As in, okay, the market's moving up and we have an average size of the candlestick, and there's actually ways you can compute this and actually trade this more methodically and spot fair value gaps. There's even programs out there to spot these things more methodically where you can have custom settings. But in our case, a visual will work just fine, especially if you're starting out. But look at the size of these candles. All of a sudden, we've got a massive red candle here that completely reverses trend. So now we've got a reversal in trend and we've got a fair value gap. So if we play this guy out and we wait for this to play out, we notice is that price comes right back up into our fair value gap. And I'll actually just draw a box here for that fair value gap. Price comes right up into our fair value gap, okay? Now, what do we do here? When we have a downside, okay, move that creates a fair value gap, what are we trying to do? Well, we're looking for price to potentially come back up and retest our fair value gap and then begin to reverse. And if we get that, it's going to give us positive risk reward. We can craft a strategy to provide positive risk reward and gives us a trading edge. That's all we're looking for. We're looking for a trading edge here. Nothing insane, nothing crazy, just an edge that gets us on the plus side of the probability. So now price comes up into this range. What I'm going to go ahead and do is say, okay, I'm going to take a short position. So I'm going to enter a short position. I don't need to get the top of this wick. I might get somewhere in the middle of the fair value gap. That's totally fine. What you could do in this scenario is you could put the stop loss at the top of the fair value gap. Now, the problem is that there's scenarios, and there will be scenarios, and it happens a lot, where price might actually come up just north and then fall back off, okay? So maybe someone has a candlestick close above the fair value gap. So in this case, we're using 1 hour candles. If we get a 1 hour candlestick that closes above our fair value gap, that's our stop loss. And then some, depending upon their risk reward, will put the stop loss at the recent swing high, which could be right here. It really comes down to how you want to craft this. Some will even put the stop loss at the top of that middle candle, which is right here. Really comes down to how you want to craft it, but I'll kind of go through examples either way. So let's say I put the stop loss at the top of the fair value gap. That's essentially drawn out by this we have right here. So if this were to be the case, I am looking for a move to the bottom, okay, of the recent range, or the bottom of the candles involved in the fair value gap, which would put us at a 4.5 risk to reward if it were to play out, which is awesome. Let's play it out. Boom. Next candle, massive move down. Fair value gap in this case acted as an area of resistance. It acted as a retest, showed us that we had a big move down. Price comes back, fills through that fair value gap, and then resumes its movement to the downside. Boom. Awesome. Now, in this case, right, you can bring the stop loss up. I'll show you an example now. If I were to have the stop loss a bit wider, right, maybe this is going to affect my risk reward. A 1-to-1 risk reward ratio is right here. A 2-to-1 means I have to get movement to here, which we ended up getting. I think a 2-to-1 is pretty good. 1.5 to 1 is pretty good when it comes to futures. I don't think we have to get caught up, to be honest, in the must be 2-to-1 or 3-to-1 when we're trading futures. As long as we have a positive win rate with our strategy, we could have a 1-to-1 risk reward. Ideally, better than 1-to-1 is what you're looking for and what we want. But if we have a 55-60% win rate that we know and it's back tested over time, a 1-to-1 risk reward is still going to be profitable. But that's the case. So now let's play this out. A couple days later, we see price start to make some decent movements, and price continues to trend down. In this case, we have a fair value gap that's developing and actually forming right now as we speak. And if I'm going to draw this in, where can you draw this in? Right in here. Nothing insane, but a nice little fair value gap that we have with a big time move down in the S&P. So moving down the fair value gap, what we're looking for is price to retrace back up into our fair value gap and then ultimately reject off. In this case, what I'm going to go ahead and do is I'm going to build out a trading plan where if we get up into this fair value gap, I'm going to take a short position. I'm going to put my stop loss at the top of the middle candle, which is going to be right here. I'll draw this in nicely right here. And then I'm going to put my take profit at a 2-to-1 risk reward, which is roughly right there. Now, I'm going to drag this across because I don't know when it's going to actually hit. But when it does hit, that's when I want to get in on this trade. So let's say time goes by, we go, market moves down, market comes back to the upside a little bit here. And now we start approaching our fair value gap. Let's keep extending it because we have yet to get into this fair value gap. And I can actually move my trade plan across the side here as well. But now, boom, price is in our fair value gap. We are now filled. Our entry would have been right here. Our stop loss is up here at the top of this. I'll draw a line right here. That blue line is where my stop loss is going to be, right at the top of that middle candle. So we stayed in it. It's in this case, see what happens here? Price comes into the fair value gap, goes just above, and then ultimately rejects. That's why it's not, having a perfect to the cent stop loss is going to be asking for trouble. That's how the markets work. Things don't work perfectly to the cent all the time. I wish they did. It would be a lot easier, right? But then that's the whole fun of the markets, right? So now we establish our risk. Our 2-to-1 take profit is down at the bottom of the green, and boom, we nail it, and we got a lot more. That right there is how we can trade the fair value gaps. Again, this can be customized. You don't have to trade it the way that we're looking at it right here, but it's a great strategy for a retest in a trend or even a break of trend, looking for reversals. What I look for, though, is big candles. Give me some big candles. Once we have some big price movements, we're looking for some retracement. And if we push up into that retracement or down, I guess it could be the opposite and a move up, which we showed at the beginning, then we're looking for that reversal to ensue and continue in the direction that the fair value gap initially signaled. Thanks so much for watching. Any links, resources linked up down below. Make sure you are subscribed. Check out the sponsor of today's video, and we'll see you guys in a future video. Peace.